Good afternoon, everyone. Thanks for joining me today. We are going to go through a strategy update, the opportunistic equity and opportunistic strategy. Today is actually my 7-year anniversary working at Waterfront here. So I'm going to talk a little bit about the history of the OS and now the OE. When I started with Roger, 7 years ago, we had the idea that indexing would be very popular and a lot of people would want to put their money into S&P 500 index funds. And that's a reasonable approach. We do it for many people here at Waterfront. But we also thought that there was going to be parts of the market that were largely ignored. Some of the small cap stocks, a little less analyst coverage, and there'd be an opportunity to complement S&P 500 investing with this style of investing, this sort of small cap value style of investing that we focused in on. And so we started the opportunistic strategy in September 1st of 2016. So we now have a 6.4-year track record on that one. It's been a good 6.4 years. We'll go through that in a little bit, some of the ups and downs that have occurred. And then a few years ago, we decided that we wanted something similar to the OS, but a little different flavor, the OE. And we're going to talk about some of those differences here, why we put in place the OE. And now we have two strategies that serve a somewhat similar purpose, but have a little different flavor to each of them. The OS has a 250,000 minimum. The OE is going to be raised to 150,000. Why is it a little larger for the OS? Well, it's largely because of bonds. We're actually happy to report that our bond trading costs will be lowered quite significantly here. So that is a good development here for the OS and for Waterfront in general. But we do have up to 20% bond allocation for the OS. And because of that, we don't want to be burdening any of the accounts with bond trading costs. So we require a little higher minimum. That's the primary reason there. The OS is a little less concentrated. OE targets right around 50 stocks. We will hold smaller portions of stocks in the OS. A lot of trims occur in the OS where outright sales occur in the OE. So when you see that column turnover, there's definitely more of a buy and hold approach to the OS. The OE is a little more tactical. Some outright sales versus a trim, as I just mentioned. Track record, OE now has a 3-year track record, so that's good. And security style, we do in the OS use some funds, particularly for international allocation. And the OE is 100% individual stocks, so that can create a little more volatility as well. And both are very tax efficient. We just went through that last year, and any client that invests in these strategies that needs some tax planning, we will go through and sell appropriately in those accounts and either be out of the market with those positions or look for swap positions, which we do in many cases. So we definitely focus in on taxes for clients that need that approach. Cap gains tend to be a little bit higher in the OE because, as I said earlier, a little more turnover. If we think it's a sale, sometimes in the OE, I just cut it, the whole thing. And sometimes in the OS, we'll trim the position. And so it can lead to a little higher capital gains taxes. Both have a similar management fee. So over the past 6.4 years for the OS, it's been a pretty good run, good solid compounding returns. Assets have grown, and there's a lot of data on these slides. This gives you the history of the returns yearly. It has had some volatile years, some very good years, and I'll get into why we've had a few very good years in upcoming slides. But this gives you a track record. One thing I do want to point out is that we are not at all concerned with the number of portfolios in either of the strategies. All trading is done through an average price account and is automatically pushed out to the various individual accounts. So the ability to execute a trade with hundreds of accounts versus 50 or so really doesn't matter. It's all done with average price accounts, so no concerns on that front. So when we started talking about devising the OS over 6 years ago, close to 7 years ago, we wanted to put something out there that was a good complement to the S&P 500. And if you look back over the past 6+ years, let's see if that's been the case. I would largely say yes. So if we go back to the start, in 2017 was a great year for the OS. It had really strong returns. You look at the S&P 500 during 2017, it had a good year, but it wasn't anything spectacular. And then you fast forward to the next 2 years, 2018 and 2019 were struggling years for the OS. It lagged. And the S&P 500 had good years in those particular years. Now, when you see the big sharp drop in early 2020 on COVID, the cyclical nature of the OS, those stocks were hit particularly hard with the COVID sell-off. And then but when the economy turned out to be better than feared, they rebounded significantly. I particularly remember the Pfizer 95% moment, November of 2020, and the stocks in the OS just took off that month. That was a extremely strong month, just because of the cyclical nature. And just to remind everyone, what makes it different from the S&P 500? Well, we're really looking for a lot of stocks that have, cyclical stocks that have low earnings multiples. They have low earnings multiples because they're not as high quality as most of the S&P 500 companies. And a lot of those S&P 500 companies, very stable earnings, high return on invested capital companies. A lot of the companies in the OE, they have a whole lot of volatility in their earnings. Some of these material stocks had incredible earnings power coming out of COVID, and it's turned negative for some of them. And those type of companies I gravitate towards. They tend to trade at lower priced earnings multiples, cash flow multiples. And if you're willing to accept the volatility of that stock, over time, they should provide a superior return because their growth prospects aren't measurably different than a lot of S&P 500 companies. They just trade at a discount because of some of the volatility inherent in their business. The other thing that I'm really focusing on is margin improvement. One of the primary determinants of returns is margin improvement. Companies that can get their business to operate at a sustained higher operating margin than they previously had been able to tend to have a big re-rating in the market. And if you can catch one of those re-ratings where the company goes from 8 times P multiple to 15 times, I mean, those create monster returns. And that happens from time to time. There's a lot of examples of that. For whatever reason, some companies are perceived to have inferior management, inferior business prospects. And if management can prove that that's unwarranted, that gap will close to peers. It will. And if you find those companies when that margin gap closes, if they're able to increase their margins, that multiple gap will close to peers. And that is a powerful combination, because if you think about it, if they're moving to a higher sustained margin, then that creates more profitability and that leads the stock price to go up. But at the same time, if the market is willing to pay more because they think they're a higher quality company, then that creates a big surge up in stock price. So those two dynamics are really powerful. It's really the main focus of the OS and even the OE. The OE has a little lighter track record, 3 years, but what you can see here, you can just see how sharp the move down was during COVID, and so stock prices of many of these OE companies, and they're cyclical companies. I definitely study balance sheets very much, and it was certainly a very scary time, but a lot of these companies were going to end up being okay, and that proved out as you got later into 2020, and they just surged back up and had a great 2021. And so they're volatile. There's no doubt about it. Some of these stock prices can be volatile, but over time, what the OS chart and the OE chart have showed you is that there are potentially superior returns to be had. A quick note on the benchmark. The benchmark for the OS is the 70% Russell 3000 value and 30% all world ex-US net tax. Why that net tax is thrown in there, because we don't do any add back for withholding taxes on foreign dividends. OE is a Russell 2000 value, and that just tends to have a little more risk profile to it, a little more of that small cap flavor to it, and so that's why the OE is the Russell 2000 value. Top holdings. Well, this gives you an indication of how it's positioned. If we just look at opportunistic equity, you can see many international companies there at Covestro, Germany, Societe Generale, France, Suzano, Bayer, Mitsubishi, Hitachi, ThyssenKrupp, Embraer, Capstone Coppers, Canadian, Sanofi. All these are international companies. And I'm a little bit high with large cap than I normally would be, and a little definitely higher with international, just because I perceive the international opportunity set to be a little better. Clearly, the stock prices trade at a discount, and I view their the growth dynamics in international markets as just as good as the U.S. There's a lot of reasons why those are the top holdings, and I'm giving you just a quick overview. The quick overview is that the OE and OS are set up for international outperformance, and they're a little bit more defensive in that if you have some fears about stock prices and economies, you tend to go a little upwards in market cap, and it tends to be a little higher market cap than is normal, but that's just a quick comment there. And just to give you a sense of how high the international allocation is, the OE is now at 57%, and that's at the extreme of what it will be. There's just, in my opinion, and a lot of these are multinational companies, so they trade at a discount when they may have peers in the US that operate on the same three main continents with the same sort of asset base, doing the same sort of things. But just because they trade in Europe, they trade at a discount. So we'll see how this plays out, but this is definitely the big theme for the OS and OE in 2023 is how heavy the international allocation is. Why is that international allocation so high? Well, one of the reasons is the US economy. All the talk has been about inflation, and we are starting to see inflation come down. It's projected to be less than 2% this year, core CPI. Excuse me. So that the inflation narrative has driven the economy and the stock markets for the past year, and as that comes down, people are going to start looking beyond inflation. We have a projected recession this year, the most forecasted recession ever, as people like to say. Will it come to fruition? Probably. But many people are thinking it's a shallow recession. We'll see what happens. As we get past inflation and into a possible recession, the markets are always forward-looking, and you have to look beyond that point. What is going to be the actual growth rate of the U.S. economy in upcoming years? And I think there's some structural problems. And what these charts show is, right now productivity is pretty poor. Hasn't been that great pre-COVID and has fallen off since COVID. And we'll see where that goes. Certainly, automation, technology, AI can help in that regard. But right now, it's not where it needs to be. When you have poor productivity in the upper right here, I'm showing job growth projected to slow this decade. A lot of that has to do with demographics and things like immigration. And so, slowing jobs, slowing productivity, those are not good things for structurally strong growth. We do have a lot going on in Washington. The debt does matter, especially when the Fed is not buying it. It tends to show up. That will create some problems in the future. Tends to hurt productivity and tends to create some problems. So it can't be ignored. And so that's why I throw that chart in about federal debt. So at this point, we'll just leave it at that. Happy to answer any questions you have. Feel free to email me or anyone at Waterfront. And just to summarize, the OE and OS are really positioned for international outperformance in 2023. But it's always a dynamic investing environment that could change as the year plays out. Thank you for your time.